Good morning all and welcome to this morning's video. So I have the same pair on watch again today. That is Euro Kiwi. So I'm going to break this down for you. If you saw my video that I made yesterday, then you'll know a lot of what I was going to say. It will just be the same stuff. As I've said previously, it's not about, trading is about consistency. It's about, if you find this boring, me repeating the same stuff over and over again, then that's good because we're trying to do this in a mechanical way, okay? A mechanical way, as much of a mechanical way as possible, okay? So just repeating the same things over and over again to get consistency, okay? If you want to be a consistent trader, then you need to be a consistent person. And if that means repeating the same things over and over again, as you would do if you were a tennis player, for example, you see them before a tennis match just repeating the same things over and over again, okay? And that's what we're doing as traders as well. So, Euro Kiwi, I'm going to break down this pair on the weekly chart today just because I've got more time. Just thought I'd go into a little bit more detail. But why am I looking at this pair? So, I am looking at this pair because on the higher time frames, if we just look at the higher time frame structure, we look at this high here dating back to 09. We have this big sell off. We then have a retracement, which I think is about, there we go. Bang on 50%. I hadn't checked this before I went live, but a lot of these things I can just do by eye now. You can just see whether something's a healthy enough pullback. But we have this high here. Price leaves a footprint. Okay, the clue that we were likely to tap into this is that we had a near miss to this high. We then sell off, come back up, and when we have these near misses, we usually tap into the high that we near miss to. And we usually break above if we're going to see a big move to the downside, and we see that here. And it just so happens that this was a 50% retracement of this overall move. Okay, so we have the sell-off at this moment in time. There's no need for us to come all the way back up here because we washed out all of the liquidity that was sat above here and above that sharp move here. You hear me talk all the time about sharp moves. We have a sharp move up, sharp move down. Okay, so it's no surprise to me that we gravitated back towards that area. Okay, we then have price that leaves another footprint. Okay, we move to the downside, we come back up, we break the high, we push to the downside, but we don't really fully commit this time, and that may have something to do with the fact that this was about a 70% retracement of this overall move. That may have something to do with it. Okay, so longer term, because we've retraced that much, we may be coming back up to test that high. Okay, but looking at how price has moved, okay, so we tap the high, come down, we have this very sharp pullback, come down, and then we start gravitating up to here again. We may be seeing something like a move down to where I've got my arrow. Okay, so down to there, we then come back up to this high perhaps and get something like that. Then perhaps we sell off from there, take out these near misses. Then perhaps we come back into this area because this high near missed to it, and maybe we break above. Okay, particularly if we've tagged out, if we tap all of these lows. So if this came down and washed that low out, then this would be more likely that we would get something like that to then tap into this high again because of the fact that this high has retraced about 70% of the move down from there to there. Okay, so we don't need to know, as I said yesterday, we don't need to know what's going to happen next to make money. We just need to be able to manage risk. But this is how you build a thesis. Okay, this is how you build a story, as it were, a narrative, as I said at the beginning of this video. So you can see on the weekly chart, we have this very, very bearish sell-off there, but we ended on a bit of a wick. When that happens, we usually consolidate sideways, and that's exactly what happened. I like the fact that even to some extent on the weekly, you can even see a reversal structure. You can see a first drive, second drive, and then a third drive, okay? And if we just drill down to the daily chart, you can see that we tapped into, it doesn't really stand out on the daily chart, but we have an area of consolidation. So we have this overall bearish move there. There's an area of consolidation sat there, and we tap into it by way of a reversal structure. Now, if we just go down to the 4 hour, why would that be? Well, you can see here, I don't normally just go down a time frame and then come back up, but for the purposes of this explanation, I think it helps. So we have a bit of a running channel here, okay? This is where volume this is where volume was built, okay? And the volume that was built in there caused price to smash through this low, okay? And we get a very, very aggressive sell-off. So when that happens, that if there was a lot of volume built in here and enough volume to cause a massive sell-off, then it's likely that there will be a lot of stop orders and sell orders placed above there. It's an area of significance, okay, because it caused, although it's not the high of this, it is where volume was built for a move which broke a low where there was a lot of volume set above. So the fact that we didn't even stall in this area and we just smashed through it suggests that there's a lot of volume was built in there, okay. And the other clue, as I said yesterday, is that we got to it by way of a reversal structure. Yes, we did break above here, but if this is an area of significance, I would anticipate a little bit more of a break than that. So it's no surprise to me that we get this corrective sell-off, as I didn't mention in yesterday's video, but which I do often mention. We get a corrective sell-off. Why did we get a corrective sell-off? Why did we see this 1, 2, 3 and the second touch? If we tapped all the volume that was there, why did we move down like this? Nature theory. We moved off correctively because people were trying to sell this, whilst the orders that were still up there and being placed in that area were dragging price up, so that you get the seesaw effect. And then what happens? We move to the upside. We wash out all the people who sold here. We tap into all the orders that were sat above, and then we see the aggressive sell-off to the downside. Okay, so this is human psychology and market nature playing out over and over again. So the way I'm seeing this now, because we had this very, very aggressive sell-off, I'm seeing this as an impulse correction continuation to push lower. Okay, and that would take us down to that area if it was of a similar length. If, because of how much volume has been built up, the volume can dictate how far we go when we break. Okay, so that would take us down to around that area, okay, where there was a sharp move. Okay, so if I just drill down, so I'm just going to switch to Euro Aussie. Okay, so obviously Euro Aussie moves very similar to Euro Kiwi. I know a lot of people within our Falcon community, within our private community, took Euro Aussie yesterday. Now, the reason I didn't take it is because it was a higher risk position, and situationally, I'm not in profit for the month because none of my entries have shaped up again. So I don't take higher risk positions until I'm in profit by 2% for the month or more. Okay, only lower risk positions. Now, if we just take Euro Aussie for a minute, and I was using this as a bit of a, to kind of ascertain what was happening with Euro Kiwi, right? So we've got all of this volume here. Okay, we break below, we kind of retest the back end of all of this volume here. We come back down. If we just zoom in, you can see that we were consolidating here at the time, and then there was a little entry here. So we had this structure here, then we had the impulse down and the correction afterwards. Now, one thing I've noticed from my trading journal is that when we are effectively floating between value areas, so we're kind of between here and between there, and you can see that once we pushed up to here, we left a gap to there, which gave me a clue that we'd likely fill it. Think about what's happening here. Okay, so when we push up to this area, when we're up here, even if these candles hadn't closed, there would have been orders being placed at here because it's the next high. Okay, so if we sell off from there, we likely need to tap into those orders for price to move to the downside. And even if we did that, that would be a retracement of about 80%, 75% of the move down which has preceded it, which means that we're likely gravitating all the way back to there, okay? Which would then be about a 60% retracement of that overall move, which that would be fine because on a corrective pair such as Euro Aussie, I wouldn't be surprised if we move to the downside from there, okay? But the reason I'm bringing this up is because you had a little entry here, okay? So you could have got short with the risk entry within this structure, or you could have got short on the break. But the reason I didn't take this, as I said, is because it's higher risk, and it was between value areas. It was above here, pretty much. Certainly if you got short within it, and it was below here. So when I'm between value areas, I noticed that a lot of my losses occurred when I looked at my documentation when we were floating between value areas. Okay, and the reason what this was looking like to me is that if you'd have taken that, because we'd near missed to that high, and partly because the other clue, just to touch on it, is the fact that this flag was steep. When it's steep like that, that's often a good clue that we're going to push back up as well. I was seeing this as a potential move down like that to then tap into either that high or the one, but more likely the one above, for then the sell-off. Okay, and you can see that's not too dissimilar to what actually happened. Now, the reason I mention that is because if we get that kind of temporary sell-off, and the clue here, look at all these corrective candles, bearish candle but with a big wick below it, doji, a big wick below it, indecisive candle, indecisive doji, and then we get that. Okay, we moved down correctively. We didn't move down impulsively like we did here. We moved down correctively. So that's nature theory once again, that we're likely to push back up impulsively. If we move down correctively, we usually move up impulsively, because people are trying to sell this whilst the orders that are still above are dragging price up. Everybody that tried to sell gets washed out. Okay, and then we move up. Now, if we did, when we were down here, I was thinking if we do get that impulsive move up, that will likely take Euro Kiwi with it, because Euro Kiwi is the sister pair of Euro Aussie. So therefore, if we get the impulsive move up on Euro Aussie, we'll likely get the same thing. You can see it wasn't very impulsive, but we'll likely get Euro Kiwi pushing up to tap into that area of value. So they were kind of, the Euro Kiwi was kind of a clue as to what Euro Aussie would do, simply because we hadn't tapped into this high and because they kind of follow each other. So I was kind of studying the two. But with all of that in mind, I just thought I'd go into that. Go into a little bit of correlation there. We don't correlate too much as traders, but so I'll be looking for a tap into that area again, and then a 1 hour impulse down, followed by a 2-touch 5-minute continuation, where I would look to get short on the break. If I got a 15-minute continuation, so that would be 6 to 8 corrective 15-minute candles. 5-minute consolidation is 6 to 8 corrective 5-minute candles. If it was 15-minute candles, then I would look for the same thing, but I'd also be looking for the risk entry within the flag, and then I'd be able to manage it down to that low for something in the region of 6%. And then because I would anticipate, because of all this momentum there, I would anticipate this following through to down to this area. So then I would set a take profit at the 90% range of the structure that price will be ranging within, where the structure that the flag was in, the type flag, and then I would set a take profit down there. And as I discovered yesterday, as I literally just did this on the fly, if we measure the impulse, so let's just get that out of the way. If we measure that impulse and we get it exact, we measure that to there, that lines up bang on with the 90% area, which is where price tends to pull back deeply, okay, even if it is going to continue in your forecasted direction. So I'd set a take profit there, and I would trail my stop loss at the same time. Okay, it looks also, I said to you, there's another thing I wanted to touch on when I thought about this after yesterday's video. So if this is the middle section, so if we have this is the middle section down like that, okay, it's not normally the case that we get a more corrective move into a more, you see the move up is corrective, but the move down is more impulsive, and then we have a bit more of a corrective move back up. It's not, middle sections aren't usually comprised of a correction, impulse, correction, okay? It's usually a more impulsive move up, more corrective move down, and then a more impulsive move up. So when I see that, okay, when it's kind of the reverse, that gives me a clue that we're more likely to get a structured approach, okay? So by a structured approach, I mean where we get a 1, 2, 3 leading up to that area, and then within that we get an impulse, a more corrective move down, and then an impulse up like that, okay? So then the middle section becomes, the middle section that we end up getting ends up, the corrective middle section that we end up getting, the more corrective middle section ends up being the one within the structural approach, because this middle section within this structure was more impulsive, okay? So that's something I've noticed as well. So that's probably a bit more of an advanced point for most of you. Don't trade this strategy. I would need to see At the moment, if we just look at this supposed structural approach, it's just a squeeze, okay? So if I was going to take the structural approach, we would need to dip a little bit and look a bit more like that. And then we would have something like that. And then if that was to occur, which could occur in the next day or so, or by tomorrow morning, if you just look at the time at the bottom of the screen, I would be happy to take a risk entry from the edge of structure, but that would take a little bit of time to play out. So for this to actually have the depth to give us that kind of structural approach. So that is Euro Kiwi. I just thought I'd go into a bit more detail today, but I hope you've enjoyed this video. And of course, if this does shape up with a trade, then I will break that down for you, give you a recap on that in the next video. The other thing is, if this whole thing starts to get wide over the next few days or weeks, it just does that and doesn't get to the value area, then this becomes more neutral. Okay, when this becomes this wide relative to the move down, it becomes more likely that essentially one of the reasons that happens is because sellers get bored. Okay, I don't know all of the reasons, but one of the reasons would be sellers get bored of waiting for this to sell off. It becomes more neutral. It then breaks to the upside to perhaps tap into that high again. And if that was to happen, we then also might be open to the idea that we come back up to take this high out because of how much of this range here from here to here, because of how much of that we retraced when price formed this reversal structure. If we were to get that down here where it became very wide, we could be tapping into that high and tapping into the high above. But we shall see. These are just things that I'm factoring into my thinking as I'm building my thesis. And the M style pattern, which is what we call that, what I've just described, that's something I'm trying to pay more attention to in my trading. So one thing I've noticed when I study my documentation is that, M style patterns are something I need to pay more attention to. So although I've learned a lot, we're always learning. All of us are students of the market, and so long as we keep that psychology first and foremost in the front of our minds, then we don't blindside ourselves and we don't do silly things like trying to sell in here like many people would have done. When it's just corrective price action, that's people thinking, yep, I know everything about trading. A lot of those people would have thought, yep, I know everything about trading. I'm just going to sell here. Many of those people would have been overlooking things which they actually knew were good reasons to stay out of the trade. But if you think you know everything, then you're just going to get involved in silly trades. Okay, so that's why these psychological patterns repeat themselves, because people make the same mistakes, like ego in that example. Anyway, folks, I hope you've enjoyed this video, and I'll see you again in the next one, which will likely and hopefully be tomorrow. Thanks very much for watching.